Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at trading-pennies.com. This week's video demonstrates the role key pivot points play when developing your stock's watch list. This week's chart is America's Wind Energy Corp, ticker symbol AWNE, a provider of wind power turbines to wind farm developers throughout North America. What caught our attention in this stock was the way that it was approaching a major key pivot point seen on multiple time frame analysis. As noted in our manual, professional traders have a thorough understanding of the market psychology behind the development of chart patterns. Professional traders understand that while the majority of traders use similar pattern analysis and technical benchmarks when making their trading decisions, they tend to do so with different time frames in mind. It is often said that a trader can become very successful using only one pattern, and this is what the majority tend to do. They find something that has a relative history of success and they remain with it almost exclusively. For example, there are those traders that have a longer term outlook on trading and tend to hold positions over periods of weeks to months. These traders look for the development of chart patterns within a longer time frame and frequency to smooth out the noise of the market that occurs over shorter time frames. These traders tend to use chart periods of 1 to 3 years and a frequency of a month to make their trading decisions. Then there are those traders that have a shorter term outlook and tend to hold positions over periods of weeks to months. As such, they look for the development of chart patterns within a shorter period and frequencies, looking to take advantage of the volatility of the noise in the market that occurs with these shorter time frames. These traders tend to use a chart period of up to a year and a weekly frequency when making their trading decisions. There are those traders that have an even shorter time frame outlook and tend to hold positions over periods of days to weeks. As such, they look for the development of chart patterns within even shorter periods and frequencies, and once again looking to take advantage of the volatility of the market that occurs in these shorter time frames. These traders tend to use chart periods of anywhere between 3 to 6 months and use a daily frequency when making their trading decisions. And then there are the true day traders. These traders have a very short-term outlook on trading and tend to be in and out of the position within the same day, or at most hold their position for a couple of days. These traders tend to look for chart patterns using the intraday charts with a period of 10 to 20 days and a frequency of 3 to 5 minutes when making their trading decisions. For example, on AWNE, we knew that there were those traders that look for breakouts and breakdowns using simple support and resistance levels. To these traders, price support and resistance levels are the interest as one, as they near key resistance levels, there's a high probability that the stock will be once again turned away, and as such a good opportunity to short the stock. 2. As the stock approaches a level of key support from above, there's a high probability that the stock will once again be turned away, and as such a good opportunity to go long the stock. 3. These pattern traders know that when the key support or resistance levels do not turn away the stock from above or below respectively, but instead are broken on volume, that there's a high probability that the trend of the stock has just changed, and they can make a lot of money taking positions in the newly forming trend. As can be seen on a simple price level, the 0.16 was significant on the monthly chart as it turned back the upward advance on 3 prior occasions. On the weekly chart, the 0.16 level turned away the stock on 9 prior occasions. As well on the daily chart, as such we knew that there were going to be a tremendous number of traders who trade support and resistance levels watching the stock as it approached the 0.16 price level from below again. We know that there are those traders who utilize moving averages as their sole criteria for their trading decisions. They approach these moving averages the same way those who trade support and resistance price levels do. As such, one has to understand that moving averages are most significant to the majority of traders within the numerous time frames. On the monthly chart, the 10, 50, and 200 period moving average are considered significant, and as such we saw AWNE approaching the overhead and descending 10 period moving average at the 0.16 price level. On the weekly chart, the 10, 40, and 200 period moving average are those used by the majority of traders, and as such we saw AWNE approaching the overhead and descending 40 period moving average from below at the 0.16 price level. On the daily chart, the 8, 20, and 200 period moving averages are considered the cornerstone amongst traders, and as can be seen, AWNE was approaching the formidable 200 period moving average from below at the 0.16 price level. With this in mind, we knew that there were going to be a tremendous number of traders who trade moving averages watching this stock as it approached the 0.16 from below, again knowing the majority were looking to take position. One of the most popular of pattern formations traded is consolidations. As noted in our manual, consolidation forms when a stock's price movement trades within a range between two established boundaries, be they made from trend lines or price points, after a directional movement in the stock's price. Visually, they can take on the appearance of either a pennant or a flag. Traders who play consolidation patterns are looking for the pattern to be broken to the upside or downside on volume before taking positions, as this indicates continuation of the stock's prior movement or a change in trend should the consolidation boundary be broken opposite the side of the stock's prior advance. To this end, we knew that a lot of traders would have AWNE on their radar as a bull pennant was forming on the monthly chart, the upper boundary at the 0.16 price level. A bull pennant was also forming on the weekly chart, once again with the 0.16 price level as the upper boundary. And again, a bull pennant consolidation pattern was forming on the daily chart with the 0.16 price level as the upper boundary. Then there are those traders who look for established trend lines and project channel formations to either the upside or to the downside. These traders place those stocks whose price levels near either the upper or lower boundaries of these channels and trade them the same way described earlier with regards to price support and resistance levels. As such, we saw the formation of up channels forming on the monthly chart, the weekly chart, as well as the daily chart. In all three charts, the stocks were moving off the lower boundary, and as such, we knew that there was participation amongst multiple time frame channel pattern traders. Putting all of this together, we saw the 0.16 price level as a significant key pivot point. It is these stocks that professional traders place on their watch lists, as they know that this is where the volume of traders all waiting to take action will be the greatest. It is these stocks, due to the degree of convergence amongst patterns, are poised to break out for explosive profits, as traders within every time frame will rush in to get a piece of the action as they see market psychology suddenly shift to frantic buying on a mass scale. But how to know when to enter the trade? This will be covered in next week's video. Until next week, from TradingPennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market.